All right, welcome back to another edition of Advanced Accounting. What I want to do is talk about Chapter 13, and specifically what I want to do is go through some examples that they talk about in the textbook and try to show you how the journal entries work for nonprofit corporations, not-for-profit accounting. In general, if you ever want to start a not-for-profit corporation, realize this. It's not too hard to start a not-for-profit corporation. All you really need to do is file the paperwork online with the Texas Secretary of State. However, to get tax-exempt status from the IRS takes a little bit more effort. So with that in mind, I'm willing to talk about how I set up my not-for-profit corporations with tax-exempt status with the IRS whenever you want to hear about that. But for purposes of this class, all I really want you to do is focus on what the transactions we need to worry about are. So in this case, on the left-hand side, what you'll see here is you will get information about the transactions on the left-hand side, the problem, data tab of this worksheet. The next set, the solutions, show you the answers of what's going on. But what I want to do is make sure that you have the ability to follow along and fill in this information as we go. So the first situation we have here is Beta Alpha Psi, which is a not-for-profit corporation, allows for certain chapters to operate independently. We here at Texas Tech do not have a Beta Alpha Psi, but Beta Alpha Psi is a not-for-profit corporation that has chapters at various colleges where accounting is taught. Now, I'm from Western Washington University, so Beta Alpha Psi exists. There's a chapter that exists up there, but realize that there's also at Western Washington University an accounting society. So even if people don't necessarily meet the qualifications of being a member into this fraternity, they can still be a member of the accounting society. So Beta Alpha Psi, just keep in mind, is an accounting fraternity. It's meant to help bolster your resume, get you involved, try to help you get some insight into what the profession of accounting is all about and what it involves. So Beta Alpha Psi is a not-for-profit corporation. It operates and has multiple chapters in various colleges and organizations. So let's suppose that Beta Alpha Psi receives a contribution of $1,000 for general use. This is not uncommon. Beta Alpha Psi gets a lot of donations on a regular basis from firms, corporations, and individuals, especially accounting alumnus from various institutions. But most of the time you see those contributions made at the chapter level. So just kind of keep this in mind as we're going forward here. What we're looking at is Beta Alpha Psi, the corporation overall. Let's say, for instance, that they receive cash of $1,000. Fine. Debit cash, $1,000. How would Beta Alpha Psi report that on its income statement? Well, things you need to keep in mind is, as I go across from left to right here, the stuff in blue is all the balance sheet items. Then we get over here to the, this stuff right here should be in pink or red. Let me change that really quick here. Sometimes the default is a little bit retentive. So the stuff you see here in red, overall the stuff in orange, highlighted in orange, is on our income statement. But what you see here specifically in red are the things called restricted accounts. So when people donate money to a not-for-profit corporation and they impose upon the nonprofit to use the money in a specific way, that money must be used for those purposes. But if money is being donated without any restriction, which most donations are, as in this case, then generally speaking, the contribution is considered unrestricted. It's called contribution revenue in the sense that, hey, you know what? People make donations. And if they don't have any stipulations, we'll just call that contribution revenue, unrestricted. So the stuff you see here in orange is what you see on the income statement. But the stuff you see here in orange, but also in red, are the things where people make contributions, and it is necessarily revenue, but it has certain restrictions attached to it. And we'll talk about different ways in which that is accounted for. So just keep in mind, a basic contribution to a 501c3 organization results in the nonprofit corporation debiting cash for $1,000 and crediting contribution revenue. Unrestricted, but you don't need to worry about that so much, right? From the donor standpoint. From an accounting standpoint, that stuff kind of matters. Let's move on to the next journal entry we see down below here. Suppose a company, let's just say Amazon, or let's just say Nordstrom, Starbucks, whatever, somebody from a corporation which generally gets tax deductibility for any contributions to a 501c3, donates certain office supplies, in this case, actual physical assets, to the corporation. What do they record in this case? Well, let's go ahead and debit, in this case, supplies or office supplies for $5,000. Physical assets, when it comes to not-for-profit corporations, are recorded the same way a corporation, from a FASB standpoint, records them. So this is a slight deviation, maybe a major deviation, from government accounting. Government accounting generally expends everything. It doesn't hold supplies, it doesn't hold prepaids, it doesn't have long-term assets. Basically, from a government perspective, all that stuff is just expended. But here, we're kind of following more what we see in the FASB. We need to capitalize things if it has a quote-unquote future economic benefit. So in this case, we're talking about not-for-profit corporations. There are some rules in the FASB, specifically the codification, the accounting standards codification, that talks about how to account for certain assets. And generally speaking, the rule of thumb is, if you're a not-for-profit corporation, follow the same rules you would see in ordinary FASB, i.e. GAAP, generally accepted accounting principles standpoint. In this case, we receive something of value. That's not cash, it's supplies. So let's go ahead and debit office supplies for $5,000. This is a contribution. What do we credit? It's some type of revenue account. In this case, we can use the supplies however we want, just like we can use the $1,000 cash however we want to. So in this case, the default is, if nobody tells us, hey, here's what you need to do with this stuff, we go ahead and put it into the contribution revenue unrestricted GL account. So in this case, we'll just simply say, hey, thanks for the contribution of $5,000. This is the general way that most not-for-profit corporations account for contributions. They receive it in cash, credit contribution revenue unrestricted. They receive some type of asset other than cash, they will debit that asset account for whatever it is, be it office supplies or some type of equipment, who knows, credit contribution revenue unrestricted. What about restricted stuff? We'll talk more about that kind of stuff, but realize that in general, if we're talking about restricted stuff, we're talking about situations where people donate either cash or some other asset of value to us, the nonprofit, and it's directed by the donor to use it for specific reasons or specific purposes. If there are no donations, like in a church, hey, pass the offering plate around, collect the cash. If the checks, or there's nothing in there that says, hey, use my donations for this, then it's okay to call it unrestricted. It's available to spend however the church needs. But in a nonprofit setting, we need to distinguish between those items that are purely free to spend however the church wants from those that are specific to a need that the church has, either to build some type of a facility or potentially used for a specific program. In this case, thus far, people just giving us stuff and they don't tell us how to use it. It's okay to say by default, it's unrestricted. So those type of journal entries are not very complicated, but they are en masse what the corporation, the nonprofit corporation, records. So just realize that they either get cash or some type of asset, they record a credit to contribution revenue that's unrestricted. Now, what if things are more complicated? Well, these are the one-offs that I like to talk about, right? These are the things that you just need to be aware of as we go through and someone says, hey, I'm a big deal. I need to restrict things as follows. Let's talk about the AI. The AICPA is the American Institute of Certified Public Accountants. This is a national organization. If you don't recall what AICPA is, the organization, realize it's been around in perpetuity since before the Great Depression. When the stock market crashed in October, late October of 1929, the AICPA was the institute that most people turn to say, how do we account for certain transactions? So what was involved in the reconstitution of the financial markets? The 1933 and the 1934 Act, which said if you're a publicly traded corporation, you need to adhere to certain accounting standards. And at that time, those accounting standards were propagated by the Securities and Exchange Commission. And there was no such thing as the Securities and Exchange Commission. It was created in the 33 Act. The 33 Act said, hey, we now have an SEC. The SEC was responsible for determining the accounting standards. And the SEC said, we don't know what the fuck's going on. So the SEC said, hey, you AICPA members, you determine the accounting standards. So for a long period of time, the AICPA, and when I say a long period of time, I'm talking about from the mid-30s to the mid-70s, the AICPA determined what the accounting standards were for financial reporting to the SEC. So in this case, when you see the AICPA, it's still in business. What role does it have in a young accountant's life or a CPA's life? It has a lot of responsibility, but it doesn't have the responsibility of creating the standards. So it's kind of the hub that anybody in accounting goes to, whether or not you're a fraud investigator, a government accountant, a not-for-profit accounting, a for-profit accountant. It's the hub that most professionals go to say, what do I need to do? The AICPA still exists to this day. You'll probably be a member, and maybe you might contribute, as the AICPA does, to an organization that's a not-for-profit 501c3. The AICPA contributes, in this case, professional consulting services valued at $3,000. What does that mean? Well, if any of that has to deal with the organization, the not-for-profit, conducting or continuing its business, either administratively or from a strategic standpoint, ordinarily, we would go ahead and expense those services as they have been rendered. In this situation, we would say, going all the way over to the income statement, hey, look, we have some contributions. In this case, we're saying the AICPA wants to support the Beta Alpha Psi organization as a whole and provide consulting services. Fine. Thank you, AICPA. How much are those consulting services worth? From a fair value perspective, which is all that we're really concerned about, we want to record those as essentially an expense, as if we paid for those ourselves in cash. But in this case, we're not getting cash and then spending it as we ordinarily would. We're not crediting cash. We're simply saying, hey, we're a not-for-profit organization. Services, professional services, count as ordinary contributions. So I'm going to say a credit of $3,000 is warranted for any professional services. But here's the trick. You have to be very, very careful about this. A contractor donates services to Beta Alpha Psi to build a new conference facility. If you don't have any other information, you have to assume that the services added $800,000, i.e. from a fair value perspective, are valued from an overall accounting perspective. If we're talking professional services, either from a legal, accounting, or specifically from a professional contractor standpoint, which, by the way, is what a CPA is, a contractor, then we would go ahead and record that as some type of donation to our not-for-profit organization. Hey, you're a professional, you're certified, let's go ahead and treat the fair value of your services, even though they're pro bono, meaning for free, let's treat those as a contribution. $3,000 from the AICPA. What about this $800,000 here? What's that in the form of? We would go ahead and say you're donating contractor services in the amount of $800,000. And if you're doing that, realize that it is like, this is why I hate the F1 key, it is a contribution like a revenue. So we ordinarily credit revenue. In this case, we're not receiving any cash, but we have earned it. We've earned $800,000 of services. What have we received in return? Well, let's go over to our buildings account. Our buildings account would be, in this case, debited $800,000. So I debit $800,000 to the buildings account, net of accumulated depreciation, to say simply that somebody has donated, instead of money, time to actually building something I can use. So I'm not spending cash. I'm letting somebody else donate their time or their money, as the case may be. In this situation, it's the time they spend to build out a facility. So I'm going to go ahead and debit the building because it's being instructed. And I'm not going to credit cash. I'm going to credit pro bono work that someone else has donated or contributed to my not-for-profit corporation. Let's not worry about the contractor. They're going to go ahead and take a tax write-off from these services. So they're fine. They wouldn't have agreed to this if they didn't think they could get a tax deduction. So it's fine. We receive services. They say, take it, you're fine. You're good to go. Great. What do we get in return? The building. We're starting to construct a building. And that is the major difference between a not-for-profit and a for-profit corporation. Ordinarily, things we would pay for, people donate to us. And they do so because they get a tax break from that. Pro bono services, tax-deductible contributions to the Goodwill, the Salvation Army, things like that. All they need to know from us as a not-for-profit is, hey, how much is the fair value of my services or the goods that I contribute to you? And they need that so they can get a tax write-off from that. What if the donation has a little bit more of a nuance to it? I like to use the word nuance, as some of you have pointed out. So suppose Beta Alpha Psi receives a $20,000 donor-designated donation to the fund for Best Practice Awards to the chapters. Okay, what does that mean? You're giving us money? Fair enough. So I'm going to go ahead, in this case, say, fine, I'm getting $20,000 in cash. But you're telling me in this situation, it's not unrestricted. You're telling me it must go to specific things. And this is the second most common type of donation, a cash contribution that requires the not-for-profit corporation to do something specific for it. So imagine the donor is saying, look, I don't just want to give you $20,000 in cash and say, spend it on whoever or whatever. I want it to go to reward or incentivize people to work hard. You as a donor can specify that in any donation. In this case, if you were a donor of $20,000, and mind you, it's not uncommon for my friends and family to do this amount, if not larger. You can say, I want you as a not-for-profit to use that money for specific reasons. If it's done with a restriction, then we're talking about the stuff in red. Restricted donations are a bit of a headache to the not-for-profit corporation, but you know what? That's not your problem if you're the donor. If you're the donor, you can specify whatever restrictions you want. And in this case, we're simply saying it's a contribution, therefore it is revenue. So let's record it as such. But let's say that it's not something that we can just generally use for whatever as a contribution revenue unrestricted account. We're saying it's a contribution revenue restricted. You have to use the money for specific reasons. It's money, you need to recognize it as a performance contribution. What's the next thing to deal with? Well, down below it says to record reclassification of net assets. So you have to imagine that time has gone by and we have acknowledged that the $20,000 that was restricted can now be released. We're going to spend the money on a specific chapter to recognize them for certain performance. So, best practice award. Fair enough. What do we record in this case? Well, we would say, hey, 20,000 needs to be released. So take that 20,000 that's restricted and call it net assets released from restricted. This is a key aspect of what we have to do. You have to follow that up immediately with a net assets released unrestricted account. Notice on the left-hand side, they're debiting the restricted, crediting the unrestricted. What does that do? It essentially moves it from this red category to this orange category. It's all reported on the quote-unquote income statement or the statement of activities. But realize that first, in order for something to go from restricted to unrestricted, it needs to have this journal entry. Once the journal entry is recorded, then what can we do? We can go ahead and credit cash for the 20,000 that goes to the specific chapter, and we can go all the way over to an expense account called awards expense. Debit $20,000. That is how we take something that's been donated to us for a specific reason, record it as restricted, unrestricted, and then finally expense it. This process is confused by most people. I hope it's not you in this case. But realize this is a necessary component. This is the most problematic aspect of the chapter. Let's move on to the next thing. Suppose Beta Alpha Psi receives documented promises to contribute $1,000 within the next year. Thanks a lot. You're promising to pay us money in the future, but we'll go ahead and be a little bit skeptical about that. So what do we do in this case? Well, first and foremost, we have to acknowledge the fact that even though we haven't received cash, there is some value to a promise. And this typically happens during a fundraiser of some kind. Someone's on the telephone and says, hey, do you want to contribute money? They say yes. We say, great, can we get your contact information? We get the contact information, and then they record it. So we have a legitimate claim to say, hey, perhaps we have the ability to collect $1,000 from people. But we know that potentially 50 of that might not be collected from people. Generally speaking, in a fundraiser, most people will follow through with it. But we also know that some people just get caught up in the moment. So what do we do in this case? All right. If we are a for-profit corporation, the 50 gets recorded as a debit to bad debt expense. We're a not-for-profit corporation. We received a promise of $1,000, but the net is $950. How do we record this? The same way we do with a government agency. We would go all the way over to contribution revenue restricted. And we say $950,000 is our revenue that we've received, the net realizable value of our revenue. Always want to show in our revenue the net realizable value. But in this particular case, because it was promised and not actually given to us in cash, we cannot necessarily go around and claim a bad debt expense to people who on the phone got caught up and said, oh, I'll give you $1,000, but they turn around and they don't give us that money. We have to be diplomatic and say, look, practically speaking, we're using the net method in this case. Revenue of $1,000, net of bad debt expense. And so some of these comments I've left in there for you to sort of explain what's going on. We'll go ahead and treat a receivable of contributions the same way we'd record the receivable of property taxes if we're a government agency, which in this case means record the net amount in contribution revenue, but in this case restricted, not unrestricted. It's restricted. Why? Fundamentally, any type of contribution that has certain conditions, meaning that a certain event has to occur in order for this revenue to be realized as earned revenue or contribution unrestricted revenue, certain events need to transpire in order for that to happen. In this case, what is the event that we're waiting for? The event outstanding is the fact that we haven't received any cash yet. When we receive the cash, that event will transfer this amount of $950 over into unrestricted. That's the process. If we're unsure or we need an event to happen, put it in restricted, then transfer it over to contribution revenue unrestricted. That's the key. What's the next journal entry here? This is the most tricky part of this chapter, dealing with contributions several years out into the future. What if a donor agrees in writing to contribute $5,000 per year to BAP for the next 5 years? Hey, that's very nice. We appreciate the contribution. What is the value of that contribution today? We have to do a present value of future cash flows calculation. In this situation, we want to be very careful. The contribution receivable account represents the gross amount, $25,000. But we know that that's the gross amount over the next 5 years. What's the present value and how do we report that? Guess what? We show that in the contribution revenue restricted account, meaning that the event time has not passed yet. So it is a contribution that requires time to pass. Not for a specific event, but if you want to call the time an event, fair enough. It is an event overall. That event has yet to pass. So at this point in time, we have to record the present value. And I recommend you get used to this. Present value function in Excel. What's the rate? In this case, they tell us it's 4%. Assume it's a compounded annual or 1 time per year sort of present value calculation. What is the number of years or the NPER, number of periods? 5 years. What is the overall amount we expect to collect at the end of every year? $5,000. 5 end. So the present value in this case is $22,259. If that's the present value, then what's the discount amount? Well, it's the difference between the gross amount in the present value amount. 2,741. When we report the net realizable value of this particular donor's contribution, we would say it's worth 22,259, and oh, by the way, it is restricted, meaning that certain time periods have to go by in order for us to actually recognize it as money we can spend. For right now, it's just a promise. It's not even cash. We'll get the cash later. Now, in this case, we need to acknowledge that as time passes, we will generate the full $5,000 per year. 5,000 times 5 is 25. So what's up with this 22,259? Guess what? There is an embedded interest component to this. But I don't want you to worry about that right now, because essentially we're not going to acknowledge an interest income in this case. We know that the full 5,000 we receive each year is comprised primarily of this principal component, but there is a small amount of interest that we do recognize as time goes by. So as 1 year goes by, we acknowledge, in this case, that approximately $890 of quote-unquote interest has been earned on this. Another way to look at that is to simply say, take the 2259, let me back this up, equals 2259 times what was the overall interest rate? 4%, 890. We're going to get rid of this discount little by little each of the next 5 years. 890 becomes now part of this accretion, or shall we say appreciation, of the overall contribution revenue. The contributed revenue amount that's restricted in total is $25,000. But we have to start, because of time value of money, we have to start in the basement. We have to say right now it's worth 2259, but as we increase it every year, we will get up to the 25,000 little by little. So what does this result in right now? An accretion of 890. In the next journal entry, we say, hey, look, we actually have received the cash contribution of $5,000. So up above, we were promised $25,000. We actually received $25,000 in cash. So what we can do is go over to our cash column. Cash received was $5,000, which means the overall contribution receivable can go down $5,000. That's the gross amount. But what does that mean from an accounting standpoint? From a present value perspective, we saw that the overall contribution of revenue, contributed revenue, was, as a present value, $22,259. It had been brought up with 1 year of appreciation to $23,149. In this case, what I want you to think about is the fact that we now have released net assets from this restricted account of not just the 890, but also the overall amount which has been released of $5,000. We have earned now $5,000. The cash has come through. So that means that the overall amount that's been released from restriction has been $5,000. So 890 represents the appreciable amount, 890. Therefore, the other portion that has been released must be the difference. $4,110. Now, in your book, they show you that net assets released from restrictions on the restricted side totals $5,000, which in this case it does. But I'm here to tell you that that $5,000 represents two components. One is the $890 in quote-unquote interest receivable, interest from the present value calculation of $890, and the other portion of the $5,000 represents release of this 2259. And if you're still iffy about present value future calculations, I want to offer you to go over to the far right hand side here. Go over to the far right side for me to explain what's going on in this case. 22259.11. That's the amount that we initially record as a present value of these future cash flows. As 1 year goes by, we've earned essentially $890.36 on that potentially contributed amount. That brings up the present value of that total receivable to $23,149. Then we collect $5,000. Once we do, the overall balance of the receivable goes down by that full amount, $5,000. But 1 year later, guess what? We've earned another $725 or 4%. That brings up the balance to $18,875. We collect $5,000. It goes down to $13,875. And on we go. What does the overall performance look like? Let's go out to here and bring this sucker down as follows. You can see that this represents an amortization of future cash flows of a specific annuity. An annuity is a fixed payment amount in the future at regularly scheduled increments of regularly or consistent amounts. We were expecting to receive increments regularly once a year of $5,000. So what does that look like from a present value perspective? It starts off at 22591. There's interest earned on that promise, and then it gets paid off. And the remaining balance earns interest, it's paid off. Earns interest, paid off, earns interest, paid off, earns interest, and then it goes to zero at the end of the 5th year. Total amount of payments is $25,000. But we start off by saying, hey, look, what would it take for us right now? What's the present value of these future payment amounts? It's 22591. So every year that goes by, we acknowledge that there is this somewhat amortization interest amount that's embedded as part of this contribution. The person is not just giving us $5,000. The person is giving us $5,000, which is comprised of, guess what? $890 of interest, of time value of money, us sitting and waiting on them to pay us $5,000. So when we get $5,000, we say, hey, thanks. But in reality, we acknowledge what? That they've really given us 4110 of their promise. And the other amount, the remaining balance of the $5,890, represents us sitting around and waiting for them to give us that money. That's the time value of money concept from a not-for-profit receiver of donations. We are releasing, in this case, from this 2259, we are releasing from that for the first payment 4110 and another $890 in interest or time value of money charge. The total amount we receive is $5,000. And we call this NA release, net assets released unrestricted, which for us is another way of saying contributed revenue. Rather than just straight up giving us cash for $5,000, which they could give us $5,000 in cash, debit cash. If they did, we would credit contributed revenue unrestricted for $5,000. But no, what did they do? They said, we promise to give you $5,000 a year from now. And we say, that's great. We record that at its present value, or a portion of that at its present value. We recognize an interest component, and we say, a year later when they give us $5,000, hey, thanks for the $5,000. Really, you're giving us $411, $4,110, and $890 in interest. You might as well give it as cash from the get-go. But this is how people donate money. So I'm just showing you how it's done. As an alternative perspective, right? We always got to look at the alternative perspective. Assume that somebody promised us $5,000 per year. But we say, more like $4,000 when you look at the overall credit worthiness of the person, right? We will still go ahead and acknowledge that there is $25,000 worth of promise. But we're saying, hey, look, about maybe $4,000 per year is collectible. So, oh my goodness, equals. So maybe 5,000 of that is uncollectible. Come on, Excel. So maybe $1,000 per year times 5 is uncollectible. Fine. That's 20,000 net realizable value. But what's the present value of this stuff? Well, equals present value. And mind you, when you calculate present value, you're calculating, if you don't put in a negative sign, you're calculating what's the present value of money outflow, in this case, assuming inflows. Don't worry about that right now. Present value at, let's see here, 4%, number of periods 5. If we're saying, well, it's more like $4,000 we expect to collect, that's the true present value of those cash flows. I agree, hey, I believe you, but I really trust my own instincts to say a present value of 4,000. It's the 5,000. What's the discount in this case? $2,193. That's how we determine the present value if we are careful about estimating the probability of collectability in this case. Otherwise, we go about and do the same procedures we've seen above. What is the next one? They give you an example in the book about Make-A-Wish Foundation. By the way, if you've never looked at Make-A-Wish Foundation, it will tug at your heartstrings. There's a lot of people. March of Dimes is another organization you might want to look at. In general, if you ever want to look at how, there's certain organizations that seem very benevolent at face value. But if you really want to know how much they truly care and contribute toward their cause, look at navigate.org. charitynavigator.org. In fact, let me see if I can pull it up here really quick. Charity Navigator. There it is. Easier to look it up on Google. charitynavigator.org. If you ever want to look at how well a certain nonprofit corporation spends money, go to charitynavigator.org, then type it in. So Make-A-Wish. Now, I want to caution you, there are many different types of organizations that have that name. Some of them are just chapters. Some of them are the actual corporations themselves. So realize Make-A-Wish Mississippi, Make-A-Wish America, right? There are different types of quote-unquote Make-A-Wish foundations, Make-A-Wish Oregon, right? Each one of these may show up in your charity search. But if you're talking about Susan why. You know, Susan G. Komen. This one tends to take a lot of flack. Susan G. Komen for the Cure, in this case, would be the overall head organization. Whereas if you're talking about Atlanta or a foundation of some kind, they tend to be specific for specific purposes or based on specific chapters around the United States. So when you go into these, click on them, they will give you a rating based, no, I don't want to do it. They will give you a rating, overall score. And you just want to be aware of this because a lot of people think that they're donating money to a good cause. But is their money being used efficiently? That's what this whole rating score is all about. You know, I've seen Susan G. Komen for the Cure be very low rated. Over the years, it's increased over time. But the cool thing about charitynavigator.org is that you can actually go in and look at their overall mission, impact information, financial performance metrics, accountability, income statement. We like to look at that, right? And you can look at contributions, gifts, total contributions, programs, services, etc. And the overall rating is based off of how much of their contributions go towards their actual purpose or their mission. So you look at program expenses. Notice it's hyperlinked. Administrative expenses, 13 million. Is that too high? I don't really know. Let's look into that. They tell you what the definition is from a 990 standpoint. As a person who started charitable organizations, the 990 form is the annual financial statements that you remit to the IRS to tell them essentially, hey, here's our tax exempt information from a performance perspective. And 990s are dedicated towards people who are tax exempt organizations or organizations that are essentially tax exempt, not people. Total revenues, they give you the information. Expenses breakdown based on the program, based on administrative function, based on fundraising. It used to be for a while there for Susan G. Komen, the fundraising used to be unbelievably high as a percentage of this overall pie. Over the years, they've actually brought it down to say, hey, we need to allocate our funds more towards the actual purpose. But that's why Susan G. Komen for years generated a lot of publicity. Because why? Because it was all about fundraising. So this is a great way to check out information about the charity that you're interested in. We're not particularly concerned about that, but Make-A-Wish Foundation, they give you information about that. You can look that information up. It's publicly available data. What we're interested in looking at are just these journal entries. So in this case, a donor promises in writing, which is legal, to contribute $1 million if contributions by other people totals $1 million. So this is a promise, right? Like most of our promises, but we have to be very careful about this. If we receive the actual cash in advance, we will acknowledge that we received $1 million. But do we call this revenue? Well, in this case, we have to be very, very specific and say, look, it's possible that some of this $1 million has to be paid back based on the donor stipulation. So we're not going to call this restricted or unrestricted. We're going to call this a liability, like we would unearned revenue. Someone's given us money. That money is available to us if there are certain stipulations that have been met. So in this case, it's a different type of restriction. This one's saying, hey, look, the performance depends on actual events actually transpiring. If they don't transpire, the money must go back. This is a type of contribution not-for-profit organizations do not want. If you operate or help with a not-for-profit corporation and you receive a donation like this, you want to refuse it. Period. I've seen this blow up too many times in people's faces. If this cash potentially has to be remitted back, consider not accepting it in the first place. It's okay if this cash is received with stipulations, but not based on other people's generosity. If the cash is received because, hey, this needs to go towards certain program expenditures, not for general salaries and expenses, that's fine. But if the cash is received because dependent upon other cash being raised, generally speaking, as a not-for-profit corporation, as someone with experience, I will tell you, we would refuse it, because that cash is as good as liability, unearned revenue, restricted completely. We don't have the ability to spend it. It's set off to the side. It's not even considered. It will be part of the total assets and the total liabilities, but it's not something that can be spent. Therefore, it does not end up as our overall fund balance. So these type of things happen, and if they do, I recommend making sure that people go ahead and turn them down, or say recommends those stipulations being changed. If in this case the metrics are met and the cash can be kept, what happens to this liability? It goes away. We get rid of that. In which case we can say fully that we have contributions that are unrestricted. Now that goes a long way, right? From going from, maybe we get to keep this $1 million to, oh, maybe we get to calculate it or keep it as overall revenue. And I say that's too much of a risk. And the smaller the amount, the less it's worth tracking. Tell people, especially for small money donors, if it's contingent upon other fundraising activities, tell them thanks, but no thanks. That's my recommendation.
All right, so up above, we looked at a situation where someone gave us actual cash and said, hey, if this doubles, then you can keep it. Fine. What's another similar situation? And that one is what we're going to talk about next down below. Suppose a large CPA firm gives $1 million to Beta Alpha Psi. The $1 million in principal is to be left intact, and the income earned of the principal must be used to fund some type of annual award. Okay, fair enough. They're going to go ahead and give us cash. But in this case, this is where I sort of debate a little bit with the authors. They're going to set up a restricted cash account. Generally speaking, all the money that we get can be put into different types of cash accounts. Usually each cash account in the general ledger will be tied to a specific cash account or bank account with our local bank or banks in some cases. So in this situation, they're saying that, okay, we've received money, but it's immediately being earmarked for something that we're definitely going to spend it on. If the thing we're going to spend it on has never occurred or how should I say this? If we get cash and it's to be used for something we do on a regular basis, we can go ahead and put it into a restricted cash account. So let's put in $1 million. If we get cash, but someone says it's contingent upon some event happening that may or may not happen, then we would put it into the cash account, and we would record it in a payable of some kind or a liability like we saw up above. So this is somewhat of a different situation. We're getting cash. It's for a next upcoming event. So we can go ahead and keep it away from our general cash account. What do we do in this case? As we've seen before, a cash contribution generally is something that we would say is, okay, on the income statement, a contribution of revenue unrestricted. But this is a little bit different. This one does have a restriction. It's meant to be used for a specific upcoming event. So let's not put it in the unrestricted category because we know it's very much restricted for something in particular. Now, I left a little note in here to tell you how it differs from above. This future event is likely to happen, and the contributions for a specific use. That is very different than what we saw up above, where the cash we receive is contingent upon an event happening in the future, but it may not happen. So we did not record it as a restricted revenue item because technically that money isn't revenue until an event actually occurs in the future. But that event may not even happen. Okay, so this is a major distinguishing feature about this journal entry. If we've got, as down below, a restriction based on something we normally do, it's okay to call it a revenue item restricted. If it's cash that we received, but it's contingent upon an event that may or may not happen, perhaps it has never happened in the future, then we don't want to call it revenue yet because there's a likelihood that it may have to be paid back. Those are the distinguishing features about these cash contributions. Now, in this case, they're telling us, take that $1 million and invest it. Fair enough. Put it in the investments, and we'll let that sucker ride. Down below, they say that the investment generated $50,000 of income, dividends, interest, whatever you want to call it. So cash was received from this investment payout. Now, this is to be used for a specific purpose. Again, look up at the top here. Principal must be left intact. The income must be used to fund an advisor award. So we know that there's going to be an advisor award in the future. We're going to leave the $1 million alone, but only use the 50,000 payouts as the amount that we're going to use to award somebody. So it is revenue. It's a contribution. It is revenue in the sense that it is used for something that we don't have to, it's for something that we're not going to have to pay back. So it's definitely a contribution. But this type of revenue is restricted to being an investment. It's locked up in an investment. The income it generates for a short period of time will also be considered interest income restricted. So both categories are restricted, but this type of restriction is just a temporary restriction. This one is cash that we receive that we'll turn around and pay out. Once we earned that money, or once the investment has earned that money, we then wait till the award ceremony, and then we release it. We set not a debit to offset this. We set up an offsetting debit in a different account. So we're going to release the amount, $50,000. It seems kind of ridiculous and tedious, but this is just a way to keep track of the storyline. If we try to mix everything together into one account, it becomes very confusing. These items show up on the income statement or our statement of activities, so we want to be clear about how the whole story unfolded. 50,000 was earned, then we're releasing it. It's now becoming part of our unrestricted revenue. Be careful when you read these accounts. The net assets released, restricted, is offset by net assets released, unrestricted. That's why these accounts are set up. Once it gets over here into this column, you can consider this now revenue that we can use. When we pay out the 50,000, what do we show? Credit 50,000 to cash, then go all the way over to the awards and debit 50,000 awards expense. What a tedious pain in the butt process this is. But this one illustrates how not-for-profit accounting differs substantially from for-profit accounting. When we have money that's been earmarked or set for specific reasons, we have to kind of go through this multiple stage process where it becomes restricted, then it's released, then it's used. It's restricted, it's released, then it's used. Restricted, released, then it's used. Keep that in mind as you're going forward and doing this stuff. I know it's a little bit of a tedious process, but this all ends up on the income statement and tells the story more accurately. Now, it's not uncommon for people to donate us things other than cash. In this case, assume that we have received a donation of a building with a fair market value of $1.5 million, 25-year estimated life, and no restrictions on its use. How do we record that? Well, it's not cash, but it's a different type of an asset. So let's go ahead and go over to buildings and debit for buildings $1.5 million. what do we credit in this case? We didn't pay cash, so it's kind of like somebody donated, gave us money, and then we use that to turn around and buy the building. In this case, we didn't get any cash. It was straight up just handed over to us. So let's go over to, in this case, the contribution unrestricted account, contribution revenue unrestricted, and that's where we record that donation. Remember, this is the fundamental account that we use when we get most contributions that are unrestricted. Either in the first example, we initially got cash and we credited contribution revenue unrestricted. Now we're getting something else that's physical in nature. In this case, it's the building. We're still going to credit contribution revenue unrestricted. I lost my place here. Go back down. There you are. Okay. 1.5 million. What they don't tell us this in the book, but this is what we have to do afterwards. Once we have this thing, we're going to have to depreciate this like we ordinarily would from a FASB perspective. So we've got the 1.5 million divided by 25 years, $60,000 of depreciation. That would be recorded as accumulated depreciation. Go all the way over to depreciation expense, and we plug in our 60,000 debit as depreciation. No big deal. That one is pretty straightforward. They give us another example down below and say, but what if really they're just giving us the use of the asset? We're not really buying this thing. Someone else is transferring the ownership for a short period of time, almost like a lease, but we're not really renting it. So someone has contributed to us something worth 1.5 million. And they say the difference here is we have to give it back after 5 years. The initial journal entry is still the same. Debit 1.5 million. But because this thing is not ours from an indefinite standpoint, we have to give it back. We're going to call this not contribution revenue unrestricted. We're going to call it contribution revenue restricted. We don't have full ownership of this thing, but we are getting benefit from it. So while we cannot say that, oh, we've earned this unrestricted contribution revenue, what we can do is little by little each year as we use it, we can transfer over this restricted portion into this unrestricted portion as it's been earned. In this case, imagine 1 year goes by. Okay, how do we go from a restricted to an unrestricted? We have to release it. So if we own this thing if we're going to use this thing for 5 years, let's release 300,000 each year and show that as actual now unrestricted revenue. It seems kind of tedious, right? It's a building, right? But it's been donated to us, the value of which we cannot say that we have fully realized until a year has gone by. So it's called a time restriction, not a use restriction. In the case of the awards up above, where we released $50,000, that was because we were going to use the $50,000 in one of our operation activities, the awards. But down below, we're simply saying that as time goes by, we are using the facility over time, but it's the time period that's telling us we need to recognize that we have unrestricted access to this building. We've used it. Fair enough. We acknowledge that 1 year's gone by. What do we do next? Well, we can leave this alone. Once it gets into this orange category, it's now in the upper portion of our income statement. It will act the same way we would see a contribution revenue unrestricted. So when you look at net assets released unrestricted, it's similar to contribution revenue unrestricted, except that we know that the net assets released unrestricted was initially over here in the red or in the lower portion of the income statement, and now it has actually been earned, and we can show that in the upper portion of the income statement as regular unrestricted revenue. So that's what that net assets released means. It's just like another type of revenue account, only it started off as restricted. When we show that we have received that benefit of 1 year, $300,000. We acknowledge that we have revenue of $300,000 as a contribution. Now we can come over here and say we still have to do depreciation, so $60,000 depreciation expense $60,000. A little bit different, but it kind of illustrates the point we saw earlier about this whole, it starts with restricted, then we have to release and use, release then use. Now these next series of journal entries will seem kind of odd, but I want to sort of preface this by saying how a nonprofit organization generates money can vary from one organization to the next. If we're talking about a college or university, one way we can help encourage money to come in, be donated, is to say, look, we will take your money and we will invest it for you, because the college or the university has a lot of people working to manage its endowments. So managing investments doesn't sound like a college or university would really do that, but a college or university has lots of ties to investment professionals who handle endowments and other donations. So consider for a moment that instead of just going over to like what is it called? Like a Fidelity Investments or E-Trade, or setting up an E-Trade account, consider for a moment that wouldn't it be easier to just donate money to a college and then say, hey, you invest it for me and give me certain proceeds in return like I would at a regular investment company? That's possible to do that. Because why? Because colleges are used to investing lots of money for people. In this case, what we're going to do is we're going to set up what is called a charitable remainder annuity trust. And the way this works is kind of explained below. Suppose a retired accounting professional with a remaining life expectancy of 9 years, and this is key, 9 years, donates $500,000 to Beta Alpha Psi under a charitable remainder trust. She is to receive $70,000 annually for life. Okay, with the first payment occurring in 1 year. The discount rate is 6%. The $500,000 is invested. Investment income is unrestricted. So basically what we're going to do is pay the donor $70,000 per year for the next 9 years. That's part of the contract. Whatever is left over gets to be kept by the college, or in this case by the organization Beta Alpha Psi. It's a great way to entice donations, even though people are a little bit skeptical about being retired and they don't have a steady source of income. Fair enough. We'll take the $500,000 in cash up front. And this is, by the way, how certain insurance annuities work too, is you put a bunch of money in and they pay out a specific amount for a certain number of years or until you pass away. So $500,000 is given to the organization. It turns around and it's going to invest it. But first we have to ask ourselves, well, is the full $500,000 restricted? Yes, it is, and yes, it's not. So what we've got here is a situation where we have to use the money to pay $70,000 out every year. So if we were to look at this and say the present value at a 6% rate for the next 9 years, and that's a key number. If there's no end date, we just consider this unrestricted. There's an end date in mind, so 9 years, and it's going to be $70,000 per year. The present value is $476,118. And they told us, well, 119, off by a buck here. So what does that mean? That is, if we were to look at taking, if we were to invest $70,000 every single year, at the end of every year, for the next 9 years, at 6% compounded interest, we would generate $500,000 at the end of 9 years. This is just the present value of those flows. What do we do with this difference here? Well, the difference $23,882, that's considered ours. That is something that we will hang on to because we're going to invest the $500,000, hopefully generate more than a 6% return, but it will definitely generate enough return to satisfy this present value of this annuity. Realize that the gross amount that we owe somebody is $500,000. Present value is 476,118. Let's go down below and figure out how the whole thing unfolds when we make payouts. Okay, first thing we got to do is invest the thing. Invest the 500,000, and then the donation earns 26,000 interest and dividends for the year. So I'm going to sort of show this in two steps. First, we get 26,000, and we're going to show that as essentially part of this annuity payable. We owe that money to the person that's going to get paid out. Then we also acknowledge that there's an increase of 4,000 to the investment account. That is also to the benefit of the person who's getting the payout. So there's the 30,000 right here. What happens at the end of the year when we pay somebody out? We credit the 70,000 and we debit the annuity payable. So you can kind of see that this annuity starts at 476,118. It's going to go up in value and then down with payments. Up in value and down with payments, kind of like this sort of step function. Our goal is to make sure that we have enough money able to make the 70,000 payments every year for the next 9 years. And that is a substantial amount of money from a gross perspective. On the gross perspective, it's $630,000. From a present value perspective, it's 476. So we want to make sure that we take this 500 cash we have and it generates enough money to cover gross payments of 630,000, hopefully enough more. If our donation, if the 500,000, the investment account generates more than $630,000 in investment income, we get to keep the remainder. That's the key aspect of this. Or more importantly too, if this donor passes away, kicks the bucket, dies, we get to keep, as part of the contract, whatever is left over. The annuity gets reversed out as unrestricted revenue if this person dies before the annuity is paid out. That's one of the reasons why we're happy to take the donation and invest it for this donor. This seems kind of ridiculous. The college, the nonprofit organization, whatever it is, they're not investors, but they're happy to do it for a donor because that donor might pass away, in which case the bulk amount left over goes to the not-for-profit organization. That's why they do this kind of stuff. So it's not kind of conniving. It's legitimate. It's a way to sort of generate contribution revenue. Now, this one is slightly different. It says, suppose the retired professional with a remaining life expectancy, again, of 9 years, donates $500,000 under a life income agreement. This one is a little bit easier to digest for us. So they give us $500,000, and they're saying in this case that only the income generated from this investment is going to be used to pay out the person. So if there are gains, if there is interest or dividend income, that stuff gets paid out, but the rest stays behind. So the 500,000, we know right away that 500,000 in this situation stays with the not-for-profit organization. 9 years goes by, whatever's left over gets kept by the not-for-profit organization. So cash goes out and goes into the investment account. They tell us down below it generates 26,000 of income. We acknowledge that is now part of this life income payable account, which is essentially to say that the donor only cares about the cream, the extra stuff at the top that has been generated from this investment. It says, don't pay me back any of the 500,000. Just pay me, if it does well, pay me that portion of it. I only want to skim off the top, if you will. There is also an increase in the investment value, 4,000. So we'll consider that also part of the payout. In total, how much has this investment account grown? 4,000. It's also paid out 26. So that 30,000 is all that's paid out. Not the 50,000, that's left alone. When cash is paid out, we credit 30. and debit the life payout. What's different in this case, though? The $500,000 remains left alone. This is the better situation. If a donor wants to give us money, ask them to invest in this life income agreement, in which case that we know that the bulk amount that they give us will become ours at the end of 9 years or whenever they kick the bucket. For right now, it's restricted, but after 9 years, we will transfer it over into unrestricted, and that will be ours to use however we want. Right now, it's got to be locked up in the investment. All the all the benefits generated from it just are paid out to the donor. So that should give you some idea about how to deal with some of these journal entries. I'm going to post this, make it available for you. Watch the video, and let me know if you have any questions.